Something just changed in XRP that matters more than it looks. Behind the headlines, governments, central banks, and major financial institutions are accelerating efforts to modernize cross-border settlement as global payment volumes continue to grow. That makes the underlying infrastructure more important than ever. In this video, we'll examine the latest macro developments, institutional projects, regulatory progress, and Ripple's expanding role to understand why many analysts believe the conversation is shifting from crypto speculation to financial infrastructure. See, over the last few weeks, several developments have begun pointing in the same direction. The US dollar weakened against the Japanese yen during what many analysts view as a significant policy-driven period, while governments across Europe and Asia continue refining digital asset regulation and currency strategies. At the same time, cross-border banking activity continued to expand, placing even greater pressure on legacy payment systems that still rely on slow settlement, multiple intermediaries, and trapped liquidity. Now, here's the key question. If global finance is becoming faster, more digital, and increasingly interconnected, what infrastructure will actually move value between banks, currencies, and jurisdictions? That's where Ripple enters the question and conversation. Not because of short-term price, but because its technology, regulatory positioning, and institutional relationships are increasingly aligned with the problems the financial system is trying to solve. And once you see how these seemingly unrelated developments connect, the bigger picture starts looking very different. Ladies and gentlemen, if you want the solid perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the markets. And thank you to everyone that takes the time to like and share these videos. It really helps the channel out. Now, this is what most people miss. Most discussions surrounding digital assets focus almost entirely on price. Will Bitcoin reach another all-time high? Will Ethereum outperform? Will XRP surge? But institutional conversations are often very different. Large banks rarely begin by asking how much an asset might appreciate. They begin by asking a much more practical question. Can this technology solve a real operational problem? Can it reduce settlement risk? Can it improve liquidity? Can it satisfy regulators? Can it scale across multiple jurisdictions? It's very important. Those questions don't generate exciting headlines, not at all. But often they determine which technology survives, because throughout financial history, infrastructure tends to outlast speculation. Price attracts attention. Infrastructure attracts institution, and institutions are responsible for moving trillions, not millions, of dollars every single day. One recent development attracted considerable attention among currency markets. The US dollar weakened roughly 3.3% against the Japanese yen during a coordinated period of policy activity that many market participants interpreted as reflecting deliberate government positioning rather than purely organic market movements. Some analysts argue that this reflects broader international efforts to reduce excess currency volatility. Others believe governments are attempting to improve export competitiveness. Still, others see it as one element of a much larger restructuring of international monetary relationships. The important point is not necessarily the exact motivation. It is the growing willingness of governments to intervene directly when exchange rate stability becomes strategically important. South Korea has taken steps to stabilize the Korean won through foreign exchange interventions. European policymakers continue redefining regulatory frameworks governing digital assets under markets in crypto assets commonly known as MiCA. Around the world, policymakers appear increasingly focused on building stability while modernizing financial infrastructure. See, whether these developments represent a coordinated monetary reset remains a matter of debate. But they unquestionably demonstrate that governments are paying far closer attention to payment systems and currency mechanics than they were even 5 years ago. See, history offers an important lesson, ladies and gentlemen. In 1944, representatives from 44 allied nations gathered at Bretton Woods, New Hampshire, to design a new international monetary system following the economic turmoil of the Great Depression and the Second World War. The agreement established a framework that anchored currencies to the US dollar, while the dollar itself remained convertible into gold. It wasn't merely a currency agreement, no. It was an infrastructure agreement. Let that sink in. Countries understood that rebuilding global trade required rebuilding trust. Stable settlement mechanisms became just as important as economic growth itself. Eventually, the Bretton Woods system evolved and ultimately ended in the early 1970s. But one lesson remains remarkably relevant today. Major monetary transitions rarely occur overnight. They unfold over years, sometimes decades. Markets often notice only after the infrastructure has already been built. Today's environment is very different from 1944. No one can confidently claim that a new Bretton Woods-style arrangement is immediate. But many observers believe the world is once again entering a period where payment architecture is becoming just as strategically important as monetary policy itself. Let this sink in, ladies and gentlemen. This is massive. But here's where it gets spicy and interesting. The conversation is gradually shifting away from simply creating digital currencies. Instead, attention is moving towards something even more important. How do these digital currencies interact? A digital dollar has limited usefulness if it cannot communicate efficiently with a digital euro. A tokenized deposit becomes less valuable if settlement remains fragmented. Central banks may issue their own digital assets. Commercial banks may tokenize deposits. Private companies may issue regulated stablecoins. But unless those systems communicate with one another seamlessly, many existing inefficiencies remain. Interoperability becomes the key. This is one reason why financial institutions have devoted increasingly attention to distributed ledger technology capable of connecting multiple payment ecosystems rather than replacing them. See, the future may not belong to a single digital currency. It may belong to whichever infrastructure allows thousands of financial institutions to interact effectively and efficiently across hundreds of jurisdictions. One of the most closely watched initiatives reflecting this broader direction is the Bank of International Settlements, Project Agora. The project brings together central banks and major commercial financial institutions to explore how tokenized commercial bank money and central bank money might operate together within a shared framework that's programmable. See, participants include some of the world's largest financial institutions. The objective isn't cryptocurrency speculation. It is settlement efficiency. Recent demonstrations involving dozens of international banks showed that blockchain-based infrastructure could facilitate a real $1 million cross-border payment across 6 different currencies in approximately 8 seconds. That's so massive. Write that down. Compare that with traditional correspondent banking, where settlement frequently requires multiple intermediaries and can take several business days, depending on jurisdictions involved. Reducing settlement time isn't just merely about convenience. It reduces counterparty risk. It improves liquidity management. It lowers operational costs. Those benefits become increasingly valuable as cross-border payment volumes continue expanding. See, Ripple is not presented by the BIS as a settlement layer for Project Agora itself. No. So it's important not to overstate the relationship. However, Ripple has long-standing partnerships with several financial institutions participating in similar institutional initiatives, which is why many market observers continue watching its role closely. That distinction matters. Separating confirmed adoption from broader market expectations helps maintain perspective. Let this sink in. Now, this is what most people miss, unfortunately. Technology alone rarely transforms financial markets. Regulations do. Institutions managing billions or trillions of dollars require legal certainty before adopting new infrastructure. Without regulatory clarity, even superior technology can struggle to achieve widespread institutional use. Write this down. This is massive. This is very important. Regulatory progress has attracted substantial attention in Europe. The implementation of MiCA provides one of the world's most comprehensive regulatory framework governing digital assets. See, rather than operating within legal uncertainty, companies now have clearer rules surrounding licensing, issuance, reserve requirements, and consumer protections. See, for firms focused on institutional adoption, regulatory certainty may prove just as valuable as technological innovation. Ripple has worked extensively towards obtaining regulatory approvals across multiple jurisdictions, including Europe. That positioning distinguishes itself from certain competitors still navigating evolving regulatory questions. Institutions typically prefer predictable legal environments. The clearer the rules become, the easier long-term infrastructure planning becomes. Short-term noise, long-term structure. That distinction could become increasingly important as digital finance continues maturing. History provides another fascinating perspective. See, during the Industrial Revolution, railroads fundamentally transformed commerce, not because trains themselves were revolutionary, no, but because they created standardized networks capable of moving goods farther, faster, and more efficiently than ever before. Entire industries emerged around those transportation corridors. Manufacturing expanded, trade accelerated, economic productivity increased. The greatest long-term beneficiaries were not often the companies selling individual products. They were not. They were the businesses that owned or enabled the infrastructure connecting entire economies. So today's financial transformation may share a similar dynamic. Instead of moving coal, steel, or manufactured goods across continents, modern infrastructure moves capital, securities, stablecoins, tokenized assets, and cross-border liquidity. So if financial markets continue becoming increasingly tokenized over the coming decade, the infrastructure connecting those assets could become just as valuable as the assets themselves. Because in every era, the systems that connect markets often become more important than the markets alone. And that brings us to Ripple's latest strategic move, one that shifts the conversations beyond payments and into the very mechanics of digital money itself. Because if the future isn't simply about moving value faster, but about creating, redeeming, settling regulated digital dollars on demand, then the competitive landscape may be changing faster than many investors realize. And that's where the story becomes even more compelling. Ripple's recent introduction of Mint reflects that broader evolution. Rather than focusing solely on moving digital assets between institutions, Mint is designed to help authorized organizations issue, manage, redeem, settle regulated digital assets on-chain. Write this down. In simple terms, it provides infrastructure for the full life cycle of a digital asset. Very important. That includes creating new tokens, redeeming them when they're needed, managing reserves, and integrating those assets into existing financial frameworks. For institutions, this is significant because digital finance isn't simply about transferring money. It's about managing programmable assets in a way that aligns with existing regulatory expectations. Some observers describe this as bringing functions traditionally associated with central banks or large financial market infrastructures into a blockchain-native environment. That comparison should be understood carefully. Ripple is not replacing central banks. Rather, it is providing technology that regulated institutions could use alongside existing financial systems. If tokenized deposits, regulated stablecoins, and other digital financial instruments continue expanding, platforms capable of managing those assets efficiently may become increasingly valuable. This illustrates a broader shift. The conversation is moving beyond cryptocurrency as an investment. It is moving towards blockchain as financial infrastructure. This is so important. And those are two very different discussions. One reason this shift deserves attention is that the conversation has expanded well beyond payments. Increasingly, financial institutions are exploring the tokenization of real-world assets, including government bonds, money market funds, private credit, commodities, equities, infrastructure projects, and even real estate. The objective is straightforward: reduce settlement friction, improve transparency, lower operating costs, allow assets to move more efficiently across global markets. Accordingly to several industry forecasts, the tokenized asset market could expand significantly over the next decade if regulatory frameworks continue to mature and institutional participation accelerates. That doesn't guarantee a specific outcome, but it demonstrates that tokenization is rapidly moving from research development and departments into strategic boardroom discussions. However, tokenization creates an entirely new challenge. Once assets exist across multiple blockchain networks, they still need a secure, trusted method of communicating with one another. A tokenized treasury issued on one platform has limited usefulness if it cannot interact with liquidity residing somewhere else. A regulated stablecoin issued by one institution needs to settle efficiently with tokenized deposits issued by another. Likewise, a payment initiated in one jurisdiction must ultimately communicate with financial infrastructure operating under commercial and completely different legal and regulatory frameworks. That is why interoperability has become one of the defining conversations inside institutional finance. Rather than competing over a single blockchain network, many financial institutions are now asking how different networks can securely exchange information and value. In many ways, the future financial system could become a network of interconnected networks rather than one dominant platform. You got to write this down, and this is the most important take from all of this. But here's where it gets spicy and interesting. Liquidity has always been one of the world's most valuable financial resources. Yet enormous amounts of capital remain locked inside the global banking system to facilitate international payments. Banks maintain pre-funded accounts around the world, commonly referred to as nostro and vostro accounts, to ensure transactions can settle when requested. That model has worked for decades, but it also ties up significant amounts of capital that cannot be deployed elsewhere. Every dollar sitting idle to support settlement is capital that cannot be invested, lent, or used to finance additional economic activity. Improving liquidity efficiency has therefore become one of the industry's largest opportunities. This is one reason blockchain-based settlement has attracted so much institutional interest. The benefit isn't simply that payments become faster. Faster settlement can reduce counterparty risk. It can improve balance sheet efficiency. It can provide greater transparency about the payment lifecycle. And perhaps, most importantly, it allows institutions to manage liquidity far more dramatically and dynamically than traditional correspondent banking models ever could. For multinational banks, processing billions of dollars every single day, even small improvements in operational efficiency can create meaningful long-term economic value. Those improvements rarely capture headlines, but inside treasury departments and institutional payment teams, they can fundamentally change how capital is allocated across global operations. There's another development unfolding that deserves equal attention. For decades, international finance has relied on correspondent banking networks that were designed for a very different world. Transactions move more slowly, business hours are determined by geography, communication between financial institutions depended on legacy messaging systems developed long before digital assets entered the conversation. Today's economy operates very differently. Global commerce functions 24 hours a day. Digital marketplaces never close. Financial institutions increasingly expect settlement infrastructure to match the speed of modern business. The growing mismatch between legacy payment rails and today's global economy is encouraging banks, regulators, and technological providers to rethink how value moves across borders. This is why discussions surrounding interoperability continue gaining momentum. It is no longer sufficient to build a faster payment system or network. The broader objective is creating an ecosystem where commercial banks deposit regulated stablecoins, tokenized securities, and potentially central bank digital currencies can all communicate without unnecessary friction. For Ripple, this broader industry direction is particularly relevant because much of its long-term strategy has focused on connecting existing financial institutions rather than asking them to replace their current systems overnight. So instead of presenting blockchain as an alternative to banking, Ripple has consistently positioned its technology as an enhancement to existing financial infrastructure. Whether that approach ultimately becomes the preferred industry model remains uncertain. Competition is increasingly rapid. Large technology firms, established payment providers, financial institutions, and blockchain companies are all investing heavily in this space. But one thing appears increasingly clear. The race is no longer simply about creating digital assets. It's about building the infrastructure capable of supporting an increasingly digital global economy. And as more pilot programs transition to production environments, investors are likely to focus less on ambitious announcements and more on measurable adoption, growing transaction volumes, expanding banking partnerships, regulatory approvals, and evidence that blockchain settlement is becoming part of everyday financial operations rather than isolated proof of concept experiments. This leads to an important historical comparison. The evolution of today's financial infrastructure resembles the construction of the Roman road network. The Roman Empire didn't become influential simply because it possessed a large military. Its strength also came from building thousands of miles of interconnected roads that enabled commerce, communication, taxation, and administrative across vast territories. The roads themselves generated relatively little excitement compared to military victories, yet they became the foundation that allowed the empire to function efficiently for centuries. Today's digital financial infrastructure may follow a similar pattern. Payment rails are not particularly exciting headlines. Settlement engines rarely trend on social media. Liquidity management systems don't usually dominate financial television. But without them, modern financial markets cannot operate efficiently. Just as Roman roads connected cities, tomorrow's digital settlement infrastructure could connect banks, payment providers, government exchanges, and tokenized asset platforms across the world. Infrastructure rarely receives the spotlight. It's like watching paint dry on the wall. Yet history repeatedly shows that it often creates the foundations upon which everything else is built. There's another development that could prove equally important over the coming decade, and it has less to do with technology than with trust. Financial infrastructure only works when participants have confidence in the system. Throughout history, every major evolution in finance has required more than innovation. It has required standardization, legal certainty, operational resilience, and broad institutional acceptance. That process now appears to be accelerating within digital finance. Banks are no longer evaluating blockchain technology in isolation. Instead, they're asking practical terms and questions. Can this infrastructure satisfy regulators? Can it integrate with existing compliance systems? Can it support identity verification and anti-money laundering requirements? Can it operate securely during periods of market stress? Can it process institutional scale transaction volume without compromising reliability? Those questions may not generate the same excitement as daily price charts, but they are precisely the issues that determine whether a technology can support the global financial system. This is why regulatory clarity continues to dominate institutional conversations. Clear rules reduce uncertainty. They encourage long-term investment. They allow financial institutions to plan years into the future rather than reacting quarter by quarter. As more jurisdictions introduce comprehensive digital asset legislation, the conversation gradually shifts away from should we experiment with blockchain towards how do we integrate blockchain into our existing financial infrastructure and architecture. For infrastructure providers, execution becomes just as important as innovation. Building trusted financial infrastructure requires maintaining institutional relationships, adapting to evolving regulations, demonstrating operational resilience, and proving that technology performs consistently under the real-world conditions. Those milestones rarely create dramatic headlines. Instead, they are achieved quietly through expanding commercial developments, additional banking integrations, regulatory approvals, and increasingly transaction volumes. The next decade is to be defined by digitization of finance. Success may depend less on who launches the newest feature and more on which companies consistently earn the confidence of regulators, financial institutions, payment providers, and enterprise customers. Because in finance, trust compounds over time, and infrastructure that repeatedly proves reliable often becomes increasingly valuable as adoption expands. Short-term noise, long-term structure. That phase captures the central theme of the entire discussion. Markets will continue to react to headlines. Prices will fluctuate. Political debates will continue. Regulatory decisions will create optimism one week and uncertainty the next. But beneath those daily movements, something much larger appears to be unfolding. Banks are investing billions into digital transformation. Central banks continue exploring programmable forms of money. Governments are modernizing financial regulations. Technology providers are building the infrastructure capable of supporting a more digital, more connected, and increasingly tokenized global economy. Prices react and systems evolving. For long-term observers, that distinction may prove far more important than any individual trading session, because the biggest transformations in finance rarely announce themselves with one defining moment. No. Instead, they emerge through hundreds of incremental developments that gradually reshape the architecture of global markets. Most people only recognize those shifts once they're already well underway. History suggests that by the time new financial infrastructure becomes obvious to everyone, much of it has already been built. That is why experienced institutional investors often spend less time asking where prices might move next week and more time asking which technology, networks, and regulatory frameworks are quietly becoming embedded within the financial system itself. So where does this leave XRP and Ripple? The answer depends entirely on the question being asked. If the question is whether the global financial system is changing, the evidence increasingly suggests that it is. If the question is whether bank payment providers and financial institutions are invested in blockchain-based settlement infrastructure, the answer is clearly yes. If the question is whether Ripple has positioned itself within the broader transformation through regulatory engagement, institutional partnerships, stablecoin infrastructure, tokenization initiatives, and cross-border payment technology, the available evidence suggests that it has established a meaningful position within the evolving ecosystem. The remaining question is one that only time can answer. So as governments continue modernizing payment systems, as tokenized assets become more common, as regulatory clarity expands, and as financial institutions move from pilot programs toward commercial deployment, which infrastructure providers will ultimately become indispensable? No one can answer that with certainty today. Competition remains intensive. Technology continues evolving. Policy decisions will influence the pace of adoption, and market dynamics will continue changing. But history offers one consistent lesson. Every major financial era has been defined not simply by the assets people invested in, but by the infrastructure that allowed those assets to move. The telegraph accelerated financial communication. Railroads expanded commerce across continents. The internet transformed how information travels around the world. Now blockchain technology is attempting to transform how value itself moves across borders. Whether Ripple ultimately becomes one of the defining infrastructure providers of the new era remains to be seen. But the discussion has clearly evolved far beyond cryptocurrency alone. It is increasingly about interoperability, institutional settlement, tokenization. If you've enjoyed this deep dive and want more institutional level analysis connecting macroeconomics, regulation, financial markets, digital assets, make sure to subscribe and turn on your notifications so you don't miss any future updates. Thank you for watching, and I'll see you in the next one. Hope everyone's having a blessed afternoon, ladies and gentlemen. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. What a time to be alive. For long-term viewers of the channel and everyone who's paying attention inside the Zoom, a lot of the things that we say are coming to be. One of the most important things I want to say and touch upon real fast is that the price of artificial intelligence just printed a new low. DeepSeek's 4V Flash, officially released Friday, costs roughly 3 cents to run through a standard battery of a benchmark test. So if you compare that to Moonshot's AI's Kimi K3, that costs 86 cents. OpenAI's GBT 5.6 SOL, $1.86. And Anthropic's Claude Fable 5, the industry's top scoring model, $3.15. So in realized terms, the Chinese model is more than 100 times cheaper to run than the American flagship. Stay with me, ladies and gentlemen. I'm going to connect all this. I spend so much time talking to family offices, sovereigns, hedge funds about this. And I'm going to take the PhD for you right here. See, part of being a financial mercenary, when you got that Gucci conviction, that Gucci clarity, you see the managed chaos that's happening. You see what's happening. And every day your research gets better. Not only do you not get cut up like sushi, you feast on the sushi. You feast on people's exit liquidity because they're exit liquidity for us. This is not financial advice, just my own opinion. It retains our organization and myself in any capacity. Stay with me. I'm putting this all together and XRP. See, Japan and the United States coordinated yen buying intervention while signaling that it would not hesitate to take further coordinated action if needed. Okay, so if Tokyo must defend the yen, the Ministry of Finance may need to sell U.S. treasuries. And when the largest foreign holder of U.S. debt becomes a seller, look out. The long end will reprice. That is why this moment looks bigger than a routine currency episode, ladies and gentlemen. No. It has the feel of a new Plaza Accord in the opening phase of Bretton Woods 2.0. So since the 1980s, Japan has sat at the heart of the global yen carry trade, exporting savings, suppressing yields, helping sustain a financial order built on cheap leverage and central bank engineering. That order is now breaking down. The end of QE and the coming end of the yen carry trade mean capital markets, not central banks, will increasingly set rates. That is also why inflation narrative is so weak. Break-evens remain anchored. Credit markets are not pricing a new inflation regime. Wall Street keeps labeling every rise in the long as inflation risk, but that is intellectual laziness, ladies and gentlemen. The real story is Japan, reserve liquidation, and a global adjustment price that has been barely recognized. Ladies and gentlemen, if you add this into big tech's pivot from providing savings to demanding credit, which we go over every video here, I've been going over this again. Stay with me here. XRP coming into play, baby, the anointed one. The same companies that once absorbed duration are now issuing debt to finance AI infrastructure, data centers, chips, and powers. If you're new here, you got to go back 2 videos and listen to the rant right there. I've been telling you this. If the 30-year yield is too bad, that hurts USA companies that need to finance debt to pay for AI. I'm going to rope this all in and see how members of the Crypto Public Desk Monthly, and if you want to join, are going to see returns coming from our tips from the pits on plays that are coming because we got this dialed in. Ladies and gentlemen, one tip from the pits can pay for your entire year's subscription. Come and join over 650 actors and traders and investors who want the deeper macro research, who are learning to be financial mercenaries, learning to grind it in and out, and enjoying the gains that come with it. Ladies and gentlemen, there's another reason the long end is moving. The upshot secular forces are tightening credit conditions, and central banks need to cut policy rates to help facilitate adjustments. A global economy hooked on carry trade cannot go cold turkey. This unwind requires finesse. Secretary Bennett is starting that process, but central banks and Wall Street still need to abandon the Keynesian dogma that treats the rise in the long as an inflation scare. The deeper the shift is structural. America is escaping secular stagnation by running the economy hot through supply-side economics, deregulation, productive investment. A wash Fed would fit that world. We said this when he first got in for the job, before anyone was talking about this many, many moons ago, why he was put in the east and the west side of the tranche. The world is at war, ladies and gentlemen. They're not going to televise it. Every world war was different. You got to understand this. Japan, meanwhile, may finally be restructuring of both its economy and its geopolitical role. That is why this is not an inflation story, ladies and gentlemen. It's the beginning of a new regime. I want you to understand something. When you got this dialed in like we do, you're seeing the managed chaos. We watch RBOB 420. We watch oil. We watch the price ranges, what gets before the death from 1,000 tweets. The chaos of tweets happen and start. We see what it's doing and why. That's why things aren't moving. But I want you to stay with me here on my thesis. And if you're new here, I salute you. You subscribe to the channel. Enjoy the Crypto Public Desk Monthly. Look, being a financial mercenary, you find out what's happening. XRP is going to benefit from all of this in such massive ways. It's unbelievable. Don't lose your Gucci conviction right here and throw in the towel. Don't you do that. Don't do that. You will regret that. Things are going to change right now, but this is one of the most boring part of the financial year always right now. Right this month and right after New Year. Nobody's home playing. Nobody cares. Markets are even thinner. It can be pushed one way. That's why intervention happens. Ladies and gentlemen, the war of AI, we call the kilowatt war, is being fought right now. That gives so many trading opportunities that we're taking advantage of in the tips from the pits. It's scary in stocks, commodities. You think that I want you in the comments. Tell me, do you think it's whacked? Or do you think it's crazy? It's coincidental? Or call it what it is for what we say every week in the Zoom call. I rant and rave on why we are in industry. It's war. Financial war. It happens when there's interventions. They press on us when we're weak. We press back on them. They're attacking the AI, making it cheaper. So what, the whole world use their LLMs throughout the world? Only the Western nations use what we're producing? We hit them with energy. We hit them with metals. They hit back this way. We got to be able to finance the players that are going to help win this AI war for us. They're issuing more stock. Normally they're buying stock. Our enemies and adversaries, the BRICS, the units, the other side of the tranche, they understand that the 30-year, they got to finance this. They understand how they're financing and what financial instrument they could press to touch somebody, hoping to cut a big, chop you up with sushi. So they know to do that. That's why it's very coincidental that headlines come out about AI being cheaper, that they could do it cheaper. They could always do things cheaper. I got news for everybody watching this. You can't copy a system forever that you need to beat. At some point in your life, you're going to have to create something that you're not copying. But make no bones about it. Intervention, treasury, yield. AI comes out on the east side of the tranche. They can do it cheaper. We're doing it more money. 86 cents, $3.15. That's wild. They see unfortunately, the weakness in the 30-year, they prance by making their LLMs cheaper, by making the market on the west side of the tranche going down. XRP is going to solve a lot of problems, ladies and gentlemen. It's just whether or not you have the conviction to hold it. So as a financial mercenary and not getting cut up like sushi, we're paying attention to a lot of things right here. I cannot believe I'm giving this all away for free. If you want to learn to trade, ladies and gentlemen, you want to learn to invest, and you want to take advantage of all the tips from the pits that I am about to go over inside of our Patreon, do come and join the Crypto Public Desk Monthly. Join over 650 active traders, investors who are taking their own destiny into their own hand. We're only taking another 350 people. Once we get to 1,000, we're slamming the doors, and you can be on the waiting list. There are so many investment opportunities that are going to come out from this scenario that we've identified, and why this is happening. I'll see you all in the front lines. But this is why this is happening. They flex on us, we flex on them back. That's what this is. This is financial war. The world's at war. It's different this time. The only question is, can you see through the minutia? Or are you going to have ungats in your account? What is it going to be? I know where I'm going to be. I'm born for this. I'm designed for this. We talk about things. If you're new here, you should love knowing what's going to happen before it happens. You listen to the rants, the Italianized part of the candy here. You listen to this. Forget about it. You're so far ahead of everybody else. My God. It's one thing to report the facts. It's another to capitalize and make money off of them. I don't care about clicks. We're mercenaries. We're financial mercenaries. I care about us being right. Ladies and gentlemen, we will look back at this point in time in history and be blown away because we're going to win the AI war, baby. We're going to win. Let me tell you this right now. I know people are hurt. They're sad. They're upset about XRP. I get asked on the phone from family office, do I think that XRP's exit liquidity and all blah, 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 blah. No, it's not. To make an omelet, you got to break a few eggs. You have to have the conviction right now, that Gucci conviction, that Gucci clarity. We're at the frostiest part of this march up this frosty mountain, ladies and gentlemen. I can't tell you how many concessions we have developed in the most austere regions around the world. All right? And you got to wait for a number of factors to happen to cash in on it. The metal's got to be above your entry price. So many things have to go right, but as long as you goose this Gucci conviction, you goose this, you keep your conviction. You understand why you're going. XRP is going all the way, ladies and gentlemen. We're going to look back at this. People would always ask, I wish I had the opportunity to get this at prices. It's here right now. There's going to be a V-shaped recovery, ladies and gentlemen, but we're at a financial war. So my recce, we're looking at the AI war. We flex by intervening in the financial markets. They come out and say, our AI is cheaper than yours. We can do it cheaper than yours. Hoping to put pressure on stock prices in the United States of America, on U.S. AI companies. Write that down. This is free tidbit right here. And write down everything that affects this symbiote and my thesis. I'm telling you right here as a financial mercenary. This is free for everybody in the XRP army, baby. Don't lose your conviction. And in the end of my thesis, I see where XRP will be priced. I do. I'm not going to share that on YouTube. I'll share that in the Zoom calls. And why? I love when I'm right, when our thesis is right. I love you all, ladies and gentlemen. I'll see you on the front lines. None of this is financial advice. This is my own opinion and entertains any capacity. Always consult a licensed financial advisor before making any investment decision ever. Never, ever, ever invest a single dollar from watching a YouTube video. Never invest money from watching a YouTube video. Our videos are for educational and information purposes only. I love you all, ladies and gentlemen. Have a blessed evening. I'm going to see you on the front lines.